All right, Accounting 2 kiddos, welcome to Chapter 20, which is one of my favorites. It's on determining merchandise inventory. We're going to talk about LIFO and FIFO and all of the different inventory recording controls that can be put in place by a business. But to start off with, we're going to talk a little bit about stock records for one and just the different ways that we can figure out what our inventory methods are. So, why merchandise inventory is so important for a business? Well, when you think about it, a merchandise business's biggest asset is its merchandise inventory. A merchandising business must then have merchandise that's available for sale that customers want. Obviously, it makes sense. If you go to a store and it doesn't have what you want, what do? You either go to the next one or you try to order it online, which then, of course, means that that business has lost your business. Okay. So a business therefore needs to have controls in place that help managers to maintain a merchandise inventory of sufficient quantity, good variety, and of course price. So the cost of merchandise inventory gets reported on both the balance sheet and the income statement. It gets put on both places. So an accurate cost of merchandise inventory goes on the balance sheet, and we need that so that we can correctly report our current assets as well as our retained earnings. Um, Also, the accuracy of our inventory cost is also needed on our income statement so that we can make sure that gross profit and net income are reported correctly. If those numbers are skewed, then we would be violating the accounting concept of adequate disclosure. So we want to make sure that we are reporting those numbers correctly. Now, when it comes to the most efficient quantity of inventory, in order for us to do that, to be able to determine that most efficient quantity, a business has to make frequent analysis of its purchases, its sales, and its inventory records. Many businesses actually fail because they order too much or too little inventory. And a business that stocks merchandise that doesn't meet customer demand is also likely to fail. So a few things might happen if a merchandising business orders too much inventory. Okay, it's more than likely going to decrease their net income, and this is why. Anytime that you have more inventory that you can sell, you have to put that somewhere. So it usually requires a business to spend money on expensive stores that have enough storage, or you're going to have a warehouse space to keep all that inventory. Also, when you order too much inventory, that takes capital that's in your business that could be invested in other assets that could then be used to earn more of a profit. It also requires businesses to spend money for additional expenses like taxes. You also have to insure that inventory, which is going to increase the overall cost of merchandise sold, which decreases net income. Also, if you have too much inventory, that inventory could be obsolete or unsellable, which would then be, virtually then that's just silly. It's hard. I mean, you wouldn't want to spend more money, and then if it's obsolete or unsellable, you'd have to just get rid of it. Now, on the flip side of that, there are merchandising businesses that order too small of an amount, and that also is going to decrease net income for a couple of reasons. One reason is that sales are going to be lost to competition if a customer comes in and you don't have the items on hand that they want. Sales could also be lost to competition if you have an insufficient variety of merchandise that is going to satisfy customers. And also, when a business orders smaller quantities of an item, usually the price paid per unit is more than when merchandise is ordered in larger quantities. So typically, the more you buy from a merchandising outlet, the more or the cheaper it's going to be. If you buy smaller quantities, it costs more. So in order to control their inventory, businesses have to take what's called a physical count, um, either monthly, quarterly, semi-annually, or annually. And it's usually this gets determined by the volume of your items, so how many you have, and also the volume of sales that you have. However, that quantity of items in inventory at the end of a fiscal year has to be determined in order to calculate the cost of merchandise sold. So some businesses may choose to do a physical count monthly, quarterly, or semi-annually, but all businesses have to do it annually in order to calculate their cost of merchandise sold. So there are two principal methods that are used to calculate the quantity of each item of merchandise on hand. The first one is called a periodic inventory, and that's where a merchandise inventory is evaluated at the end of a fiscal period. So you get to the end of the period, you look at all of the items that you have on hand, you count them up, their quantity. That's called a periodic inventory. A merchandising inventory that is determined by keeping a continuous record of increases, decreases, and their balance on hand is called a perpetual inventory. You might also hear it referred to as book inventory. We're most of the time going to refer to it as perpetual, but just that you're perpetually doing it. It's a constant process instead of one done at the very end of a fiscal year. Now, many companies use computers these days to keep track of their inventory on hand. And essentially, what this does is it allows the company to know the ideal quantity of each kind of merchandise on hand. And we do this because eventually, as people start to buy our inventory, we have to make sure that we establish an ideal minimum quantity and an ideal reorder quantity. So all this is saying is that once we hit a minimum amount on that inventory, we need to obviously reorder. And then also, how much do we reorder? And that is super important because we need to make sure we establish that because we don't want our inventory to run too long or too low. And we also have to think about how long it takes for us to get that inventory in. So it's a very delicate balance. There are jobs in the accounting world that are out there that are only pertaining to making sure that inventory is calculated correctly and also determining all of these numbers. And it's a fluctuating thing. You don't just say, "Oh, this is going to be how many we reorder," and that's all you do all year. Because think about how a business's ebbs and flows and how they have busy seasons and less busy seasons. So it's a full-time job to deal with inventory for sure. Now we have something that is called an inventory record, and it is a way to keep track of the inventory on hand. If you do a periodic inventory, which is one where you do it once a year, is where we count and weigh or measure, depending upon the items that you have for sale, um, to know what our physical inventory is. And so employees typically count each item of inventory and they record their quantities on the form I'm going to show you. And then to make sure that they do this as accurately and as completely as possible, typically they close the business in order to do a physical count. So normally businesses do this at the end of a fiscal year or when inventory is at a minimum because obviously it takes less time to count a smaller inventory. So, for example, a department store probably is going to do their periodic inventory at the end of December. They would never do it before December because that's the holiday season and it would be crazy. Um, Instead, their numbers in inventory are going to be substantially less after the holidays, like after December 25th, even right around that December 30th, probably 31st, allow time for people to come in and make exchanges, but then they would likely close the store and do their periodic inventory to make sure that they have accurate counts of merchandise. So, an inventory record is a form that's used during a physical inventory to record information about each item of merchandise that they have on hand. So this is what it looks like, an inventory record. We obviously have the date, and then this is the item. So for these beach totes, we have three different types of beach totes. So what we have here, columns 1 through 3, are the stock number description, and then obviously the actual number of units on hand. This is completed when the business is actually taking their physical inventory, going in and actually counting each of these. Columns 4 and 5, where we figure out our unit price and our total cost, are completed after the physical inventory has been done. Now, this is what we're going to learn more about later in this chapter, is how to determine unit price and total cost. We'll talk about that later, but what we're thinking about now is just making sure that we record this information correctly when you do your physical count. Now, we also can have a stock record, and a stock record is not, don't think of stock like common stock or preferred stock. When you think of stock records, I want you to think of that businesses keep continuous records of the quantity on hand for each kind of merchandise. So we call that a stock record. It's a form used to show the kind of merchandise, quantity received, sold, and the balance on hand. The thing you have to remember is that a separate stock record is prepared for each kind of merchandise on hand, and that a file of stock records altogether is called a stock ledger. Now, the perpetual inventory system, remember, provides a day-to-day information about the quantity of merchandise on hand because you're doing it continually. The minimum balance allowed for reorder is also shown on each stock record. That's very important. But remember that a stock record shows the quantity, but usually not the cost of merchandise. So you're still going to need to figure that. So this is what a stock record looks like. It has our purchase information here, and it also has our sales information here. So notice that purchases go on the increase column, obviously because you're purchasing merchandise, and decreases are for sales. And we'll talk about that here on the next slide. So increase column for sales, and then we calculate the new balance on hand. Sales information is recorded with decreases column. Obviously, when merchandise is sold, your inventory goes down. And then we make sure that we update our balance on hand after each purchase and sale. So even the thing that you have to remember about a perpetual inventory is that there often are there's a lot of opening where errors can be made in recording and calculating amounts. So we want to make sure that even if you do a perpetual record, that you should at least take a physical inventory at the end of each fiscal year. That is GAAP's recommendation that you do that. The perpetual records then, after you do a physical inventory, get corrected to reflect the actual quantity on hand in case there was an error in calculating. Now, like I said, today most people use some sort of a computer system to do perpetual inventory. We use point of sale terminals. We've talked about those before at the customer checkout counters. Those are connected to computers. We scan the universal product codes, or the UPCs, and the terminal reads that UPC that's marked on the products. And then we have computerized stock ledgers that are obviously stored in the computer. And then what happens is that when the UPC is read, the computer reduces the units on hand to reflect the items that were sold. The computer can also typically check quantities in the stock ledger and then print out a list of those items that need to be reordered, which is obviously very handy. And even with a computerized system, though, there still is the possibility that errors can be made. So again, even if you use the computer system, which a lot of times we think as foolproof, you still want to make sure that you take a physical inventory at the end of the fiscal year to update the quantity of inventory on hand. So what we're going to do over and work together is we're going to do a stock record. So I'll meet you over there.